Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about sequence of returns. And I thought this is a timely video because a lot of you are struggling with this right now. You're close to retirement, you're early in retirement, and the current market conditions is freaking you out. And I can't blame you for that. And timing of returns, sequence of returns has a big factor on how your retirement plan works. So we're going to talk about sequence of returns, why it matters, how it works, what it's all about. And I want to give you kind of some tips and tools to help walk you through this process. Part of that is psychological. I want to give you kind of peace and comfort on it's going to be okay and some strategy behind that, and also some tips and tricks to make sure that your portfolio is structured so that SOR, sequence of returns, is not going to affect your retirement. So I talk about all the time, when we build out a financial plan, I don't do a sequence of return, rate of return, because at the end of the day, we don't know what that's going to be. Now, what we're going to talk about in this video is it does matter. Right? If the first year of retirement you make 20% or lose 20%, that could be a drastic difference, especially in retirement when you're starting to draw down. It's important to know in the accumulation phase, if you're saving and plugging away, sequence of return, it matters, but it has a far less drastic effect on your income and retirement plan. It's for those of you that are starting to draw out, right? You're pulling money out, you're decumulating your account, especially if you're doing it tax efficiently, which is typically the first CPP, draw out those RSPs and registered accounts quite quickly. SOR is going to have a big impact on you. So you need to make sure you have the tools in place to make sure that it doesn't. When we build a financial plan, like I said, we're gonna level out an average return. So let's pick just 5%. So we're gonna build the plan to say, look, on average, you're going to get 5% every year. But of course, we know that you're not going to get exactly 5% every year because you can't even get a GIC for that. So we know that it's going to go a bit like this, but over time, you're going to average over a 5, 7, 10-year period, you're going to average that 5%. And that's really what we're targeting. If that first year's minus 20, then the next year's plus 6, and then minus 2, then plus 12. It's all over the place. As long as it averages 5, over 10 years, we're okay. But again, that bouncing in between, if it's down 20% and we're pulling a lot of money out, are we prepared for that? So if we're looking at the decumulation phase of retirement, as you start to pull money out, obviously, if your 100,000 goes to 80,000 and your plan shows to pull out 10,000 a year, your account's now gone from 100,000 to 70,000 really fast. And not only that, but you've pulled money out at a depressed value. If you needed 10,000, if it's lost 20%, it's costing you more than 10,000 to pull out what you thought would be $10,000. So it starts to eat away at your capital much more quickly. Again, if we're down 20%, goes to 80, you pull out, you're down at 70. To get back to 90, which is where you thought you would be at the end of the year, it takes that much more, right? If you got a 20% rate of return from 70, you're only at 84,000. You're still not back, right? You got to make a lot more on the upside. So again, that sequence of return has a big impact on you. And a lot of you watching this video, this is what you're falling into. I would say the first few years of retirement is the most important point and important stage of series of returns. And this is why a lot of you, as you enter retirement, a lot of the concern is psychological. And I think it falls around this. Like, what happens if my DIY portfolio fails me? What's that going to cost me in retirement? What happens if my mutual funds don't do well, or my ETF portfolio, my managed portfolio, whatever it is? No matter where your investments are, this can be a concern, right? And we're in it right now. The broad market has dropped off. Everyone's down. You're probably down somewhere between 5 to 30%. If you were tech heavy this year, it could be down 30% or even more. Big companies that people have been heavily invested in lately, Shopify, Tesla, these companies are down massively. If that's you, you're down substantially. And if you're early in retirement, that could have a big draw on your portfolio, thus could affect your cash flow later. Now, maybe you have enough cash and investments that it really doesn't matter and you can give it time. But a lot of you, every dollar matters. If it means that you have to pull money out right now when the market's down, it's gonna cost you potentially $2,000, $3,000, $5,000, $10,000 per year of income that's not gonna be there later on. So I wanna show you an example. And this is an example, average 4% rate of returns are very conservative. And one is retiring at the beginning of an up market, and one is retiring at the beginning of a down market. And again, sequence of events matters. So over this 15-year period, the client has averaged 4%. They've drawn out $5,000 every single year, and they started with $100,000. So it's not a big drawdown, it's only 5%, but they haven't prepared accordingly. And you can see the difference at the end of the day is quite substantial. So the amount that they're going to have at the end of the day goes from 105 down to 35. Now, this is maybe an extreme example because typically we're not going to see 4 years in a row of down markets. It could be typically more down 20% in this year, and then it's going to be up slightly next year, then down, then up. It bounces around, but rarely. In fact, if we go back through history, there's not a lot of periods that would be this long of negative performance. So that's something to keep in mind. But again, it does have an effect. I would say a more realistic example is we're down now. What do we do with that? And I think that's going to answer the question and give you peace of mind for a lot of you watching this video. So here's my recommendation and my input to this is that this year, 2022, is a bad year in the market. We're down right now. We may be down at the end of the year, maybe down even more, maybe up from where it is, but no idea. Wish I had the crystal ball. I don't. So let's take a step back. Is your financial plan. What does your financial plan show that you need to draw out? Let's say it's on 100,000, let's say it's 10,000. You pull out 10% every year, you're in your 60s and eventually start CPP. So you're kind of doing an RSP meltdown right now. That $10,000 or 10% of your portfolio, that needs to be ready to be paid to you. It shouldn't be tied to the markets. And I've talked about this in other videos. You should have 12 to 24 months ideally of cash flow ready to go. This is why I personally like dividend paying stocks in retirement, because I'm going to get my 4 or 5% right off the top in dividends. So from 100, I'm going to get cash flow of about $5,000. That's perfect. Because even if the market drops a bit, half my cash flow I need is coming to me. Then I might have a maturing bond, or I might just have some cash aside, or whatever it is, a cash-like instrument. So what happens is next year, same thing, I'm gonna get another $5,000 in cash coming in from dividends, and I need another $5,000. So really, I need about $10,000 of cash or short-term investments to meet income needs for 2 years. And again, this is 10% of my portfolio. It's a pretty high percentage of my portfolio. So this is the way to manage, regardless of what happens in the stock market and in the portfolio overall, how much cash is coming into your portfolio, and how much do you need to top it up to give you kind of that 1 to 2 years of income that's not tied to the market. So if the market does go like this, that's fine. You got cash and cash flow coming in to support that. And then as it ramps up, then you're in a good position. Again, you can never time the market, but you kind of work it with your cash flow. Again, talk to your investment person, your financial planner, to make sure that you have a clear plan and a strategy for times like this. We know, I talked about it last video, we know that we're gonna have down markets in retirement. If your retirement's 30 years and you're just entering retirement, you may feel like this is a terrible time and I need to extend my retirement. No. Get a good plan in place. This does not have to extend your retirement, and you're going to go through more market crashes like this over the next 30 years of retirement. In fact, you're probably gonna go through one every 3, 4, 5 years. And every year or every 2 years, you're gonna see a market drop at 5 to 10%. That happens all the time. Really, I keep pushing this in almost every video, is how are you prepared for that? Have you built a plan? Do you know what your cash flow need is? And you know what your cash flow is from your investment portfolio? Those two things need to come together. If cash flow need is 10,000 and cash flow from the portfolio is 5, you have a 5,000 shortfall. Where's that coming from? That 5,000 should be somewhat disconnected from the stock market and what's going on in this world. And so when we look at series of returns, yes, it can have a huge impact on your portfolio. It can have a huge impact on kind of cash flow and what you need. But if you plan ahead and give your portfolio time to come back, you're going to be okay. Again, that's going to give a lot of peace of mind and a lot of comfort to the next few years, and maybe the first few years of retirement for you. A couple other ways that you can help kind of buffer against series of returns would be lower volatility investments. So decrease risk, something a bit less volatile to the markets. Being invested in the market is like going up an elevator with a yo-yo. You're gonna go up, and the yo-yo is kind of the year to year. So the elevator going up is the long-term trend of the market, right? It's gonna go up. Your elevator is going up. But the yo-yo that you're holding and you're playing with is gonna go up and down and up and down, even though the elevator is going up over time. That's how I like to look at the markets. Now, how long is your string on your yo-yo? That's what you need to determine. If I'm standing here, I'm 6'3", so maybe I can have a string, 3 feet long? 3 feet, that's maximum risk. Maybe 6 inches, that's minimal risk. You need to figure out how long that string on the yo-yo is for you. The third aspect would be to diversify your portfolio. Again, look at alternative assets. Look at, geographic location, what you're invested in. Again, a lot of you have been invested in tech heavy. We talk to people that are 100% Tesla stock, which to me is crazy, but a lot of you have made a lot of money, millions of dollars off of that. Again, probably in the last year, you've lost millions of dollars too. But diversify. Being all in on one stock or on one sector carries a lot of risk. And when you talk about series of returns, you're at a very high level of risk to series of returns, and it's really going to hurt your cash flow, especially a company like Tesla. Not to pick on Tesla. I love Tesla. I drive one. I think it's a fantastic car and vehicle and company and all that. But they don't pay me a dividend, and they're a very volatile stock. That's not something I'd want to have all my eggs in one basket, or a lot of my eggs in that basket, heading into retirement. That would be stressful for me. And I like risk. I like that part of it. But you have to understand what you own, why you own it, and is it giving you that cash flow or the ability to pay you your retirement paycheck when you hit retirement. If it doesn't, you may need to diversify out, change your investment strategy, whatever it is. When you hit retirement, you go from, and this is the psychological side of it, you go from showing up to work and a paycheck, right? It comes in the mail or you direct deposit now into your bank account every 2 weeks. Paycheck, paycheck, paycheck. You don't really have to worry about it. Fast forward to retirement, or maybe you're in retirement, and you know that paycheck stops and you have to create your own paycheck. And that might be RSP, TFSA, non-reg, or pension, CPP, OS. There's a lot of these different silos that come in. Again, part of the plan is figuring out what silo to pull from when, but the other part of it is to make sure that that cash flow comes in consistently no matter what, and that the investment strategy and plan behind it lines up with the income need. If you're concerned about this and you don't know where to reach out, happy to help you out. Talk to your financial advisor. This is not something that you can put on the sidelines. If you're 5 to 10 years away from retirement or closer, or even in retirement, and this is stressing you out and you feel like you have no plan, it's time to take action. Too many of you are sitting on the sidelines thinking it'll take care of itself. It won't, I promise you. It's like parenting a kid. If I just leave my 4 kids to do whatever they want, they're not going to get anywhere in life. They are not going to learn anything. It's going to be a gong show. I need to actually intentionally parent them, to educate them, to train them up, to teach them how to do things. If I don't do that, they're not going to progress. It's the same with your retirement plan, your income plan, all of that. You need to actually take action and be proactive on this to make sure that it all lines up and you're actually going to get your paycheck at the end of the day from your investment account. So that's it for me today. Series of events. It does matter, but you can reduce that risk by having a plan. Retirement needs to be, joyful, happy, a time where you actually enjoy life. And sitting on your couch, not because of COVID, but because the market's down and you're fearful of spending money, is not the way to do it. So make sure you have a clear plan in place, get that paycheck coming to you. You'll be much happier, I promise you. So thank you again for joining us in this video. We'll see you in the next one.